Imagine the trading floor during the open on any given day. The opening bell rings. There's this quiet intensity that hangs in the air as traders focus in on their screens, absorbing the information presented by the stocks in play on the day. This palpable focus is broken by an occasional call out as a stock surges upward. This initial drive, while common, often results in a subsequent pullback as the dance of power kind of ensues between buyers and sellers. Price moves higher, which can attract more sellers who are ready to get more for their stock than they could just minutes before. But every so often, something kind of intriguing happens. Instead of just fading away, the stock's price kind of holds its ground. This is no ordinary play. This is the arena where a big player is making a move. When you spot such activity on an in-play stock, know that there's this colossal player in the mix, one that could potentially drive the price even higher. But why? So real institutional buying programs, they're not fleeting moments, they're marathons. These marathon runners don't sprint and stop. They know how to set an aggressive baseline pace, and they'll pick up that pace from the baseline as needed to do their job, to get their orders filled. Our task? Well, it's to hitch a ride on this unstoppable force and let it pave the way for us. So when a stock refrains from pulling back, it starts that narrative shift. On the desk, you'll hear some traders who shorted the stock on that initial thrust up with an expectation that they would quickly be rewarded with a deep pull-in. You'll hear them start to get frustrated. This stock should not be holding up like this. It should not be consolidating like this. The consolidation might vary, but our experience gives us indications that a consolidation period ranging from 5 to 20 minutes, with the low of this consolidation planted firmly in that top third of the day's trading range, is exactly what we're looking for. To the untrained eye, these may seem like random orders, but for us, they're telltale signs of a large institution putting in orders, big players at work. These orders aren't haggling for a bargain. They have a singular mission. That mission is to get filled. The market's going to yield to their desire. It's going to propel the stock higher. And our strategy is simple. We're just going to ride along. Now let's delve into the specifics. Entry rules. So the moment we enter is when a 1-minute bar breaks higher. It breaks out of that consolidation, which we fondly label the HitchHiker candle. Part of why we call this the HitchHiker Scalp is a story for another day, but that candle that distinctly breaks the consolidation to the upside is our HitchHiker candle. We want to hitch a ride using its burst of momentum. We don't want to be passive. We need to hop in aggressively. So as soon as that range shatters, we want to pay the offer for a long. We don't want to linger, wait for the bar to close. The range break is our chance to get in and catch a ride with this big player. Stop placement. Anchor your stop 2 cents below the trough of the preceding consolidation. This isn't a game of second chances. It's a decisive move, a one-and-done scalp. Picture this stock's movement as waves, ebbing and flowing, yet kind of relentless. After the first surge of momentum following our HitchHiker candle, that first wave out of the consolidation is given a rush of buying. We're going to exit half of our position. This rhythmic motion of the stock, especially under the influence of a buy program of a big player, it offers us the perfect exit strategy. It gives us a balance of riding the real momentum that occurs when there's a relentless drive for this big player to get filled with the passive but steady baseline pace that's set as the stock rests. After this rest, as the second wave initiates, often kind of grinding its way at the start with a burst towards the end, we let that rush give us our exit of the remaining half of our position. In the wide open spaces of trading, amidst countless strategies and maneuvers, the HitchHiker Scalp gives us a way to catch a ride with a big player and allow the flow of their large orders to drive us to a great scalp. In terms of stats, this scalp has an accuracy of around 55 to 60%, with a reward to risk ratio of around 1.9, which is a really solid edge. You win just over half the time, but your winners are nearly twice as large as your losers. Now that's a formula for trading success. And I just want to mention something here. So you probably see many supposedly high accuracy trading systems being touted out there by trading educators and systems vendors. You'll see things like 80% or even 90% accuracy. Now, this of course draws in traders because everyone loves to be right and have high accuracy. But what the people selling you these systems often kind of fail to mention is that such accuracy usually comes with inverse risk reward. Meaning, yes, you can be right 80 or even 90% of the time, but your losers are usually 2 or 3 times larger than your winners, and sometimes even 5 or 10 times larger. Meaning you're going to win 8 or 9 times out of 10, and then 1 or 2 of those losers are going to wipe out all your profits and then some. Such systems are rarely ever really profitable. They're just feel-good systems that are easy to sell. But do you want to just temporarily feel good, or do you want to make a consistent money? If you want to make the latter, you need to trade like the pros. Virtually all of our professional and elite traders are typically trading 50 to 60% accuracy strategies. But these strategies have larger winners than losers, typically 1.5 to 3 times larger. And that means that they have a very solid, large edge. That's what you should care about. You need to trade for overall edge, not for accuracy if you want consistent profitability. You need to let go of your need to be right on any given trade and focus on strategies that make money overall. This is the only thing that will bring you to the consistent profitability you're after. Now, having said that, let's see some examples of both longs and shorts. Our second entry was a very important one to cover. Our second example, very important one to cover because it can trip people up. So you need to be aware of this and be prepared for it. What we see here is you get a first move up and this little chop, but then a first move up with a choppy consolidation. Well, when you see the volume that's supporting it and that choppiness in the consolidation, it's actually trying to correct. But buyers are saying, I need stock, I need to get in. So we enter on that break of the consolidation. Our stop goes below the low of that range. So even this little attempt to drop out, well, what happens? The buyers step right back in where that consolidation occurs, and we ride that first wave higher. We exit half our position into the first wave. This one is a long hold. This is not a normal example for this trade, but it's important because you can see how that wave takes time to develop. But once the power of that wave starts in our favor, look how cleanly it trends and then finally capitulates with that big whoosh to the upside where we exit the second half of our position. In our third long example, we're covering this specifically because of something that can trip up traders. This is something that can kind of make people a little uncomfortable, but there's a trading concept around it that makes it such a valuable thing to cover. So we have our consolidation. We get the first buying pressure, that unusual buying pressure. And then we see this consolidation occur. And then we see the break, which gives us our entry. We can place our stop below the low. And again, similar to something we saw before, it feels like, oh no, this could fail. Well, if it doesn't fail, what is that telling us? It's actually telling us the buyers are there and they're really going to continue to support the stock. They have stock they need to buy and continue to get filled. So we can ride the moves, ride that first wave up. We exit half our position into the first wave. We see that little pull in that consolidation and then that quick and abrupt second wave higher. That's where we can exit the second half of our position and move on with this scalp. We're going to cover our first short example. This is one where we get that first move lower, we get that consolidation. You can see how we attempt to break higher first. When we attempt to break higher, it's similar to what we talked about in the longs. You get to actually see what's happening with the sellers. Are they really interested in selling this stock? When we see that, that is a really good piece of information. They're actually stepping in and selling the stock the way we want them to. So when you see that, that's actually a really nice factor in recognizing a good trading opportunity for the HitchHiker Scalp. So we can enter on the break below the range, and then we're going to use the waves to exit. We're going to get that first wave lower. We take half of our position off, and then we expect that kind of wash as we go back and forth a little bit. And then we get that second distinct wave lower where we exit our position and we move on. Again, from the open, we get this first move down. It's an unusual sort of move because it doesn't correct. It attempts to correct in this little consolidation, but it's not able to correct. By correct, I mean move back up in price. This is unusual selling pressure. It's very unusual for us to observe a stock that is doing this. So what can we do? We can try and hitch a ride on the move. When the range breaks to the downside, we enter our position short. Our stop goes above the range, which is right where those sellers really stepped in. When the buyers tried to step up, the sellers said, nope, we've got more stock to sell. We're going to continue to sell this. So we allow this to occur. We have our stop in place, and then we ride that first wave lower. We exit half of our position into the first wave. We kind of anticipate and are comfortable with that little pop against us because we're looking for the selling pressure to sustain. It does, and we ride that second wave lower. We exit the second half of our position into that second wave lower.